Good morning, everybody. Good morning to another episode of Coffee with Krav. Welcome back. Really looking forward to today's discussion. Once again, we do Coffee with Krav for those of you that are tuning in for the first time. We've been doing this now for 13 weeks. We're looking to do this going into the future as we're all sitting home, working remotely and doing more things from home. What we're looking to do is we're looking to bring you some information from different areas. We're looking to educate and hopefully also entertain you. So looking at today, just want to talk to you a little bit about research and some of the research that we do at Align Wealth. We have research, and we get research from many different sources. It's not like we look at CNBC and listen to CNN and all those other media shows, because that's what they are, our shows. We're looking for real deep, great information. So we get it from many different sources. Among those sources, Hightower itself has its own whole division. In addition, we pay for some independent research. And then also we have partners that we can get distill some great information. Now, some of that information we might agree with, some of it we might agree somewhat with, but getting that information, that all helps us make great decisions or look to make great decisions for you. So today we have Jack. I'm going to try to pronounce this correctly. Janasiewicz. How'd I do?
Very good. Very good.
We have Jack. He's a senior vice president, portfolio strategist, and portfolio manager at Natixis Advisors. He is responsible for providing insight and analysis on global economic and capital market themes and their impact on portfolio construction and asset allocation. He has over 20 years of investment experience. Before joining Natixis, Jack was a chief strategist at Duet Alternative Investments, where he assisted in managing an absolute return strategy focused on emerging markets investments, and also directed research related to asset allocation decision and security selection. His previous position included 9 years as chief strategist and portfolio for long-only and long-short global macro products at Macquarie Capital Investment. He also owns a MBA in economics and an MA in economics from Boston University, and is a member of Boston Security Analysis Society. Woo! That's a lot of stuff that you got going on there, Jack. We appreciate you joining us here today. So really what we're looking at theme is, from the market standpoint, where were we before, where we are now, where we're going. So let's go backwards for a second. So it's February of this year. US and China finally shook hands. There's no more fighting in the sandbox. Earnings look good. And then boom, like a ton of bricks falling on us, the pandemic hit. And the markets fell fast and furious. I guess my first question is, should the markets have fallen that fast and that furious back in March?
Yeah, and so, well, first of all, thanks, Mark, for having me on. A couple of things I think that are interesting with that backdrop, and with hindsight, it's pretty easy to answer that question. And when we look at sort of the V-shaped recovery that we're seeing in, I guess, stocks, but more importantly with earnings estimates have recovered quite sharply. And then when you look at the economic data, for example, to the surprise indices, so the surprise indices, which look at analyst forecasts relative to the actual numbers that have come out, you've seen a very big split between that, meaning a lot of the economic forecasts were very bearish, too bearish relative to the actual prints. And so we've seen a sharp recovery on that. I think one of the things that I've learned looking back, maybe we did underestimate the recovery in a sense of what's been delivered as a result, but more importantly, maybe we overestimated the impact of the virus and how flexible really the U.S. economy is. And we're seeing that when we look at analyst revisions coming up sharply and economic forecasts coming up sharply. So did we fall aggressively? Maybe we overshot to the downside. Some of that was technical because of the some of the functioning issues that we had in the credit markets, but obviously a lot of that changed when we had both Congress and make their announcements back in late March, as well as the
So
Fed.
I want to ask you about that. I do want to ask you about that, and just to kind of comment about that, it's a pendulum, right? The pendulum swings way too much one way and goes down too much, and sometimes it swings way too much and goes up too much. But the response rate by the government was unprecedented.
Yep.
They put trillions of dollars into the system to create a bridge. Do you think that that was the right response?
Yeah, and so it's funny. We always joke when I come into the office. You know, what can we be? What can we worry about today? That sort of seems to be the MO. And so when you do talk about that pendulum going back and forth, you know, characteristics of sentiment, we do swing widely there. And so obviously we swung too much to the downside. But you know, the response that came from the federal government as well as from the Fed was very important. And that is that to me is really the sole reason why we are where we are today. You know, listen, you had a policy response that required to address the healthcare concerns. The policy response was to shut down the economy. And when you have a policy response that says we're trying to create a recession, you better then make amends to what's been happening with regard to that. And I'm going to share my screen real quick here so you guys can see something that I think is very important. When we start talking about sort of this backdrop, the global policy commitments you can see here, unprecedented. And to your point, and I want to broaden it out, it's not just what we saw in the United States, but it's been globally. So when you look at the amount of money that's been put forward from a fiscal response, as well as a monetary policy response in relation to overall GDP, in some cases, we're pushing almost 50% of GDP. Those are huge numbers. It took 3 years during the financial crisis for us to get half of these numbers. We did this in a matter of months. And so that's very, very important and very impressive when we sort of think about this backdrop here with regard to the overall economy. So was it important? Absolutely. A policy response that forced the shutdown of the economy, which meant people got laid off. The policy response needs to make people whole. And that's what I think the government delivered on, and it did make people whole. Very important.
So let me talk about those layoffs. It's a good point. You know, we talked about the stock market that turned around, but there's many small businesses that have gone out of business. Restaurants, airlines, hotels, they're in trouble. But it seems that the market is built differently than the economy. Is that correct?
Yeah, and that's a big takeaway too. And I think that is something even we underappreciated as we started to come out in early April, sort of as the market began to bottom. And when we started to dig into some of the hardcore numbers here, that's the one thing that really stood out to us. You know, we have to separate, there's the economy and then the stock market, and they're two different things, and that's very important. And one of the things, I'm going to share my screen again to show you what I'm talking about here. You know, again, when we think about those sort of parts of the economy that were shutting down, what's interesting here, if you look at their overall sort of contribution to the S&P 500 on an earnings front, it's not quite as much as you'd think it were. So when you sort of think about all the headlines that we see, and again, the headlines are going to be quite negative on the back of this, but you look at hotels, airlines, entertainment, restaurants, food and beverage, those are the parts of the economy that were adversely impacted by the shutdowns. When you look at their contribution to the overall earnings backdrop of the S&P 500, it's basically 7%. So again, you think about the economy, yeah, we're largely a service-driven economy, but the S&P 500 is much more manufacturing. And so that backdrop, I think, is very different. It's very important to sort of notice the difference between the two. And that is a subtle difference that I think is very important here. The S&P 500, the things that we're seeing adversely impacted by the virus, not huge participants with regard to the overall S&P 500 earnings backdrop.
How about all those people that work in all those areas? Because obviously they're adversely affected. How is that going to affect the economy?
Yep, and that's the other one. This goes back to what we were talking about on your first question. You know, the impact from both the Fed as well as from Congress. And again, the policy response was to create a recession, which ultimately made a lot of people go on unemployment insurance and basically have to lose their job. But the policy response from Congress was very important because those lost wages between the unemployment insurance and the kicker that was put into place, which is that $600 bonus that was sent out each month, effectively what we saw was the amount of wages you had been typically earning that you were losing, unemployment benefits get back about half of that, but that $600 kicker then recouped that and then some. So ultimately, you were basically making the same amount of money on unemployment had you been working. So that replacement ratio, that replacement income ratio that we talk about, got back to 100%. So in effect, you had all these people that were laid off, but the amount of money that they were taking in still remained the same. And that was very important. You can see that from this chart here. You can kind of see that dip in early March. People were getting laid off, and as a result, we're losing some of that personal income from both wages and profits from the companies, small business owners. But then you can see the unemployment benefit kicking in, and you can see how that the orange line starts to tick back up and is actually above sort of the trend level. That's the difference that the CARES Act really made in terms of putting money back into your pocket. So bottom line, even though you're unemployed, your wages, your salaries, your benefits basically didn't get hit. And so the buying power, your consumption power basically was replenished. That was a big deal. That's why I think we're doing a lot better than most expect. And that also is why I think it's very important that Congress continues to extend these packages because that consumption shortfall needs to be replenished because we're still not back to full employment yet.
Okay, I want to get into that, but I have a question on that. So that extra $600 that was given in unemployment, I read somewhere that over 60% of the people were making more money than they were beforehand. Couple of thoughts that come to mind. Do you think that they had to give that much, that people should make more? And when you incentivize people to sit home, is that something that's good that you're doing, is incentivizing them? And last of the three questions here is, are we creating too much debt by doing something like that? So I'll
and these are great questions because these are what your economists are struggling with and the policymakers are struggling with. I think historically speaking, when you have these sort of retrenchments, the response needs to be go big or go home right off the bat. And so to get it right, I think at the margin, you don't know really what that number should have been. So $600, we can argue after the fact, was it too big? Was it too small? To your point, the replacement income for, I think 39 states actually exceeded 100%. So people were getting paid more to stay at home relative to work. The bottom line is the money needed to get out the door ASAP, and that's ultimately what ended up happening. And I think that actually was the right policy mix. Now we can argue in some cases, is that a headwind in terms of people returning back to the labor force? Some of the research is somewhat split on this. I've seen some papers from Yale, from the Fed, from ISI Evercore, for example, that have looked at those states where you've been paying out above the replacement ratio, so meaning you're making more money staying at home relative to what you would have been if you were working. And the job searches there are still just as aggressive. So that's implying, people at least understand that at some point that money is going to go away. I need to find a job. And there's also we've seen some research on the other side saying that people aren't returning to work because they're making more staying home. So it's a little bit of a mixed bag on that front. And that's partly what I think when you hear the estimates for CARES Act 2 and the $600 benefit, we're seeing that come down to somewhere closer to $400. But it's, at the end of the day, that's very important. Consumption matters for the U.S. economy. Those extra benefits matter because you still have close to 30 million people still out of work. We need to make them whole, and that I think is very important going forward. Your last comment about the debt, I think that's something that we're going to have to deal with, but now is not the time to be thinking about that, because the way we look at this, the downside to not responding right now is probably the impacts taking a less aggressive response. You're probably going to make things worse. And so let's sort of heal the problem now, and then we'll start to have to tackle that debt backdrop in the future. So let's make sure this doesn't turn into a depression, and then we'll worry about the debt load, and as we start to come out of this and recover.
Okay, I'm going to get back to the new CARES Act, or whatever they're calling it now, CARES Light, or I think that they talked about that today in a second. But let's talk about the whole basis of why this all started, which is the coronavirus. Where are we today? What's the possibility of a second wave? Where are we with the vaccination? I'd like to hear what your comments are there.
Yeah, and so again, very important, I think, for the outlook for the remainder of the year. And we've actually got a little bit of a different take on some of this. Excuse me. Listen, the beginning of the year, we saw sort of the West Coast and the East Coast, Northeast really get hit hard by the virus. And that kind of makes sense, right? That's where a lot of the travelers that are coming from Europe and from Asia are flying into. The South really didn't get much there. I know we sort of had the hot spots roll through Arizona, Florida, and Texas. They've since dealt with that. And I think that to me is not really a second wave. That's really a first wave. So we're finally seeing that it's work its way through the system. But I think we've learned quite a few things along the way, and this is very important, right? It took a little while for the reaction function to kick in, but when we started to see those case counts spike in those Sunbelt states, the response was slow, but it finally came. Simple things: wear a mask, social distance, large gatherings prohibited, close down the bars, takeout only. Those things finally came into being, and obviously that started to see the case counts roll over. You can kind of see this in this chart here, where the case counts, and if I extended it out to the more recent data, they're starting to roll over again, which is a good sign. And more importantly, you can, again, as morbid as it is, the fatality rate has been fairly benign. And that's because I think, again, the hospitalization, the healthcare system has gotten better at treating these sort of things, and we've learned a lot. But going forward, what's also very important to us, when you think about a second wave, don't think of a second wave as we have to shut down the economy again, right? I think what we've learned, we're going to have rolling hotspots across the United States, but we've learned that we can social distance, you can put on masks, those sort of things work. But at the same time, we don't have to have the draconian lockdowns that we saw early in this, because we've learned how to deal with it. So as a result, yeah, maybe we do get some hotspots that pop up. Maybe you have to take some stringent measures, but you don't need to shut down the rest of the United States as a result. So from an economic standpoint, that's very important. We can see some hotspots pop up. You can see certain states have to be a little bit more strict, but the economy continues to move forward, and that's very important. So the two things we're paying a lot of attention to, and these are what matter the most, I think, again, hospitalizations, pressure on the healthcare system. When we look at those hospitalizations related to the virus, are they spiking? Are they putting pressure on the healthcare system? So far, we're seeing that number stay fairly benign. And then secondly, the fatality rates. If we see a spike in fatality rates, that's a concern. We're not seeing that as well. So bottom line here, we probably will see maybe a second wave. Maybe we'll call it second hotspots rolling around. But again, I think we've learned a lot from how to deal with that. And more importantly, we probably don't need to shut down the economy on the back of that. That's very important. And then the second thing, which you highlighted as well, if you had asked me maybe 2 or 3 months ago with regards to the potential for a vaccine, it was still probably fairly infant. When I look at our vaccine count, I think we're up to about 166 different vaccines that are in test form right now around the world. 30 something are in human form. My guess is that if I treat that as a basket of lottery tickets, one of those lottery tickets probably is going to hit over the next couple of quarters. So the point here, the markets being a forward discounting mechanism, they're going to start to price in the odds of a vaccine coming. And yeah, we're probably still on the lower end of the spectrum, but again, it's not zero. We're moving up, and that's that backdrop. And that, I think, is another positive backdrop for the stock market. And that's something that's being discounted slowly every day as well.
I read about a corona mutation that is more infectious and less deadly, and was starting to see that in Europe. Is that something that you've seen as well in your research?
Yeah, I actually saw I think Malaysia was one of the places that I was reading a story about where that was popping up. And again, mutations are going to be something that would be a little bit concerning. But again, to us, it's the fatality side of the equation that really matters the most, because again, it goes back to putting stress on the healthcare system. That's the big one for us.
I just want to remind everybody that if you have a question, please email me. My email is mkravitz, KRAVIETZ, mkravitz @align, ALINE, wealth.com. So if you have any questions for Jack, please email me at mkravitz@alignwealth.com. All right, so let's take this in a different route. Let's take a look at gold. Gold has been moving up recently. Where do you see gold, and do you see it as part of the portfolio? Should it be part of a portfolio?
Yeah, this is becoming a very interesting topic, especially given the performance of gold more recently. And what's interesting, the knock on gold has always been that there's no you don't earn carry. So if I own a brick of gold or a bar of gold, I'm not getting paid anything to sit on that. And so you're looking at a competing asset class. Consider gold to be a safe haven asset class. So people will look at treasuries versus gold, right? If I own a treasury bill, at least I'm earning a coupon while I'm sitting with that. I'm not earning anything sitting with that bar of gold. But the problem now is that as rates push down lower and lower, and in this case, right, if you look at, for example, the 10-year treasury yield at 70 basis points, let's just round it to that currently, and then I take a look at where inflation is, that nominal yield, and then converting it to a real yield, meaning what am I really earning, right? I'm losing money because inflation's pushing above what I'm earning for a yield. So I'm actually losing money sitting on treasuries. That's where the value of gold really starts to come in, because it's at least retaining its value, even though there's no cost of carry. So as the real yield, meaning your inflation adjusted real yield, your inflation adjusted money you're earning on a treasury continues to go down, that makes gold more and more attractive. And so you can also argue some of the dollar weakness that we're seeing. And this is all interrelated. But again, the competing assets that we're looking at versus gold are actually looking a little bit less attractive. And that's putting a little bit more upward pressure on gold. The other thing I would point out too, as we get closer to what we call the zero lower bound, or zero in terms of real nominal yields, the potential offset for equity risk, going from 50 basis points to zero versus, let's say, a couple of years ago, treasuries were at 3%. Treasuries could go from 3 to 2%. But at 50 basis points, you can go to zero. There's not a lot of room for treasuries to rally to sort of offset any sort of downside pressure in equities. That's, again, making gold a little bit more interesting. So one of the things that we're talking about a little bit more actively from a portfolio management construction perspective, maybe you do have an allocation to gold in some of these portfolios as your hedge to downside risk. And so that's something I think is very important. The caveat to this whole discussion, though, gold investors are a little bit of a different breed, right? If you think about people who are buying treasuries, you're not quite as speculative in treasuries. Gold has a little bit more of a speculative base to it. So sometimes these relationships hold, sometimes they don't. And you're going to see some more volatility in gold prices because you have more speculators in there as opposed to investors. So that gets a little bit tricky when we think about portfolio construction in gold.
And you mentioned about treasuries. Do you think that we'll ever go to a negative treasury rate?
Yeah, that's a good question. I think that the Fed, and again, if we think about sort of Fed operating in the real short end of the curve, because obviously with the Fed funds rate in the 3-month T-bill, for example, being pretty tightly correlated, the Fed, I think from that standpoint, will be a little bit loath to go negative. I think there's a lot of issues that would impact short-term market rates. So think about money market funds. That would create a lot of problems in the money market side of the equation if rates were to go negative from the Fed. So I don't think the Fed would set rates at negative. Could the market drag us through zero into negative? That could happen. But I don't think it'll be a policy prescription that the Fed would push rates negative. The market might do that if we continue to sort of see the yield curve flatten.
Okay, let's talk a little bit about the market. The largest 1% of stocks in the S&P make up 23% of the index. The largest 1% of stocks make up 34% of the Russell 1000 growth, and that same 1% makes up 48% of NASDAQ. Those 5 largest stocks, Apple, Microsoft, Amazon, Google, Facebook, now account for 23% of the index, compared to 2000, when those top stocks made up 18%, which obviously was a tech bubble in 2000. Are we creating this tech bubble? Should we be worried?
Yeah, and this is again another one of the key concerns that we have with in our discussions with clients. It seems like anytime something goes up a lot, people like to throw the word bubble right on top of that. But you know, a couple of things I think are worth pointing out this time around. When we sort of look at the FANG names, I guess is what we'll call those for now. You know, the FANG names, think about that, right? These companies really have no debt on their balance sheet. Apple, I think, is the only one of the 5 that has actual some debt out there. I think they just might have tapped the market the other day. But you know, no debt. The cash pile on these companies is enormous. It's, you know, it's north of $1 trillion. These companies are still buying back debt. I actually went over the last 5 years. They've put forward plans to buy back $500 billion worth of their debt, which is very impressive. They come up with products we use on a daily basis, right? And I always use the example, if I'm home on a Friday night, you know, I'm sitting down to kind of relax. You know, I might put on my Apple Music, and I'm listening to some music and trying to figure out what Netflix show I want to download, and maybe I'll order out some dinner. So I'm going to pull up the menu from down the street. So I'll Google them, and you can kind of see, if you kind of go through your daily routine, those 5 names, you're always using some of their products. And so that standpoint, you know, they make products we use, and in some cases you might even consider them to have a quasi monopoly. Those sort of things, I think, are characteristics that we want to see in the marketplace. This chart here, you're looking at the relative strength of the NASDAQ relative to the S&P 500. And if you look sort of as we got into the dot-com bubble, that's how fast the NASDAQ outperformed the S&P 500. So it happened in a very small window. You can see basically after that, nice slow grind higher. And again, we've picked up a little bit towards the end here, but the point being, that nice short grind up, to me, that's just a massive accumulation. That's a shift in sort of the economic backdrop as we become more tech reliant. That's the bigger point. And then if we look at that 12-month rate of change, so we're just looking at that change over 12 months, you can see how fast, again, during the dot-com bubble we got there. We're not really seeing that right now. So is it justified? You know, I think to a lesser extent, yeah. I think some of these tech names deserve to be a bigger piece of the puzzle, but a lot of it, I think, is really driven on the fact that they're making earnings, and those earnings are a big portion of the marketplace. So some of this is justified.
Okay. Again, I'll remind everybody that if they have any questions about the markets, economy, and so on, please email me at mkravitz, KRAVIETZ, at aline, wealth.com. Okay, so we're talking about market valuations here. What do you think about the market valuations? Is it starting to get, on a general sense, not just those few stocks, in a general sense, are we getting too expensive?
Yeah, so I have a little bit of an interesting take on valuations. My take on valuations, we don't spend too much time focusing on that. You know, if you look at the data, you know, valuations really drive long-term returns. So long-term returns really go out to about 10 years when you look at the data supporting that. So again, thinking out in terms of 10 years from today, yeah, valuations will matter. I'll be honest, my time horizon isn't 10 years. That's well beyond mine. So, you know, the valuation story, I think, is not quite as important to me. And the other thing I would point out that we tend to fall back on, to me, valuations are more of an opinion, right? And you may agree with that opinion or you may not. And so it's sort of, valuations are in the eye of the beholder. You may think something's expensive. I may not. I may be willing to pay up for certain fundamentals. And like we just walked through with the FANG names, those are some pretty important qualities as an investor that I want to own. So I'm willing to pay a little higher multiple for those than maybe you are. So again, valuations, to me, more of an opinion. Obviously, we know everybody has their own opinions. They differ. There's no right or wrong answer to this one. So we spend a little bit less time worrying about valuations and really focusing more on what kind of qualities that do we want to own with specific stocks and sectors. That, to me, is the more important factor here. What do you want to pay up for?
And in terms of multiples, because you know, I've read about that the multiples are a little bit high and the future multiples are a little bit high.
Sure.
Can't you have a little bit higher multiples when rates are so low?
Absolutely.
You can't compare multiples from 10 years ago when rates were much higher, right?
Absolutely.
So you can have a little bit higher multiples.
And this is another great point you bring up. You know, you can look at it from your cash flow discounting mechanism. So obviously, when you're starting to divide a certain cash flow by an interest rate to discount that back, as the denominator becomes, you know, bigger, in this case, the percentage becomes smaller, that makes that cash flow more important. So as rates compress, drop, that puts a higher valuation on those cash flows. And so you're willing to pay a higher multiple for those companies. So you can look at it with regard to the risk-free rate. You can look at it with regard to credit spreads. We like to look at, for example, sort of the BAA sector. To me, that's sort of the sweet spot that represents the U.S. economy. You can look at it from an inflation-adjusted basis. All of these metrics point to the fact that everything is continuing to move lower, which means you probably are going to be entering into a higher multiple zone. So to your point, yeah, we probably do deserve to be trading at higher multiples because of that. The other piece I would point out, the number of issues that are available to trade on the listed stock markets continue to drop. So there's fewer and fewer companies that are listing. More and more are going private. And so if you think about that from a pool of available capital, which you can spend money on, the amount of money chasing the market continues to move higher. But if we consider the number of stocks that are listed as sort of staying, stationary or static, that's more money chasing the same amount of companies. That's going to require a higher multiple just by the pure math on that. So that's another thing to think about too in terms of that multiple backdrop. Certainly deserves to be a higher one.
I want to talk about U.S. and China relations. Again, as I referred back before February, everything looked good. Then coronavirus hit. Now things are not as good. And I just wanted you to comment on that, and also Huawei technology, how we're putting the screws to them as well. So I just wanted you to comment on that.
Yeah, and I think that this is a sounding board that becomes a little bit political as well. So, putting pressure on China, I think from a both Democratic and a Republican standpoint, resonates with the voter base. So it's not surprising we're trying to ramp up a little bit of the rhetoric with China in front of November. That was part of, I think, Trump's policy announcements way back. So that again appeals to his base. If we, depending on what happens over the elections, I don't think we're going to get quite as much of a change in rhetoric. Maybe there's a different approach to it. Let's assume that if Joe Biden ends up winning the presidency, it certainly seems like he's going to continue to put pressure on China from multiple facets, whether it be human rights issues or from technology standpoints. But it's certainly based on some of the things that he's talking about. We may be going at it through more of the multilateral approach as opposed to the bilateral approach, meaning re-engaging our allies, re-engaging Europe, re-engaging some of the Asian countries to sort of coalesce and then act in team efforts sort of to go after China and some of these fronts. So I think that the China concerns are here to stay. Unfortunately, it's sort of how we go about doing that might change. And as a result, it'll be interesting to see how this dynamic continues to shake out, but it's certainly going to be a headline risk going forward. The Huawei stuff is going to put some pressure on some of the tech companies, especially the chip makers. We saw, overnight, some of the Asian chip names got whacked around pretty good on the back of that. But there's also going to be some people that are going to step up and be key benefactors of that. So certainly a shifting landscape, and a lot of that's going to be politically driven.
Okay, I just got a couple more questions to ask you. I just want to see if you had any comments on the speculation that's going on in the Robinhood accounts. And let me just, for everybody that doesn't know what's going on with Robinhood. So Robinhood is a firm that was created, and what looks like is happening is that there's a lot of younger investors that are going into and opening up accounts in Robinhood, and they're speculating. So I guess they can't go to Las Vegas. They're using the stock market as a gambling source, and so a lot of these accounts are buying some securities, and they're going higher and then busting and going down. So just wanted to get your take on that.
Yeah, and so this is actually kind of interesting. There's a saying that goes, "Don't confuse brains with a bull market." Listen, it's great that people are getting more involved with the stock market, and unfortunately, one of the best ways to learn about the stock market is to actually lose some money. So this could actually be a pretty good learning experience for some of them. But, I think they're coming into the market at a great time, in the sense that you've got all this massive stimulus with regard to monetary and fiscal policy coming and pushing the market higher. And it certainly seems like you can't lose. And so again, that goes back to the first comment there. Don't confuse brains with a bull market. You just happen to be in the market at the right place, right time, so to speak. But I think some of this stuff is a little bit interesting, and as far as I understand it, when you place an order in Robinhood sells that order flow book to a couple of dealers. And those dealers can basically, from a high frequency trading standpoint, effectively front run some of those trades. And it's a little bit eye opening that this stuff can still be going on today,
Right.
but it does. And so, what's happening is, as these Robinhood guys put those trades through, the high frequency traders are front running it. And some of the other professional investors, they publish the holdings, and so they can kind of see the money flow. They know that these guys are basically going to buy the stock market on the open, where some of these guys can trade these in pre. So you're sort of effectively front running a lot of these trades going through. A lot of what they're buying, and there's a Citadel story that was out a while back that simply was looking at low price stock. And a lot of the Robinhood accounts were simply looking at, what's the smallest dollar price stock I can buy? I'm going to buy that because I can buy more of it, right? They're confusing that. And so those tend to be a lot more of the less traded names. So it's very easy to push those names around, especially when you have people that are not really understanding the market dynamics, that are going to end up buying it regardless of where that price may be, because they're not operating with limit orders and stuff. And so some of this, I think, the professionals might be taking advantage of some of the younger traders that are involved in this. But at the end of the day, again, with all the fiscal and monetary policy backdrop, this stuff is still going up. But ultimately, they're buying some names that are going bust, bankrupt. You saw it with J.C. Penney and Kodak, for example. And as they push these things up, they come right back down again. So, listen, it does a good thing and a bad thing. And I think the good thing is that people are learning about the stock market, becoming a little bit more in tune with it. It's an educational experience, and maybe at the end of the day, this is good for everybody.
I hope we don't lose a generation of investors that get burned here. So that would be my issue there. Any questions that I didn't ask? That any topics, anything that you wanted to bring up?
Yeah, I would just say, the biggest risk, I think, is one of the other questions that we get a lot about. A lot of it, and there's two things that that we tend to highlight here. We sort of talked about it with your opening questions. That CARES Act 2, or the HEROES Act, or whatever you want to call it, to me is very important, right? Again, it gets back to, we still have people that are out of work. People want to get back to work, but simply can't, because the virus has shut down some of these sectors of the economy and the services side, and they can't get back. We need to continue to make these people whole. And if we don't make them whole, we could see consumption take a hit. And that would obviously be bad for the economy. And at some point, that's going to spill into the stock market. So our biggest concern will probably be answered within the next couple of weeks here with regard to where that stands with Congress. So that to us is the big one. And then the second one, obviously.
Let me just ask, because we're seeing 1 trillion, 1.5 trillion, 3 trillion on one side. Where do you think this will? First of all, do you think it'll get done? And second of all, where do you think it'll get done at?
Yeah, we still think it's going to get done. Our base case is for between 1.5 to 2 trillion when it's all said and done. So we're a little bit on the upper end, only because I think for McConnell to get this through, he may have to sort of bend to the Democrats to get more Democrats to vote for this package, which means you got to bring the number up. They're at 1 trillion. The Democrats are at 3.5. If you want to get more Democrats on board, you're probably going to have to move closer to 3.5. So we're thinking there's upside from 1.5. That upside would be closer to 2. The big one there is, again, that incremental unemployment insurance kicker, $400 to the end of the year would be good. I would be great with that as a strategist. And then money to state and local governments, they need some funding in here as well. That's the number we're also looking at. We're hoping for something over $500 billion there, which kind of earmarks what we expect the shortfall to be. So those are the two pieces that we're looking for. And then the second one, again, obviously people are still expecting volatility around the elections. I always like to think about consensus the consensus right now seems to be volatility as we move towards the election. If Biden wins, the consensus to me feels like the market's going to have some weakness. Point being, I think you need to have something moving either direction outside of consensus to move the market. So you either get more worse news or better news. And I think we're seeing Biden move a little bit more to the center more recently. And, I think his policies going forward will probably not be quite as progressive as some might fear, meaning maybe we don't get quite the aggressive tax hikes right now, only because the recovery is fairly nascent. So we might think that if we do get a Biden win, maybe it's not quite as bad as some might be making it out to be. So we lean a little bit optimistic on that front too. But those are the two big concerns we hear from our clients, and I just wanted to kind of throw those out there.
Well, excellent, Jack. I just want to thank you so much for taking time out this morning, helping clear up a few different areas that we talked about: the markets, gold, the economy. We talked about China and the United States. We talked about the election. So we had all different kinds of subject matter here. So really appreciate the time that you've taken. And for everybody out there, appreciate you joining us once again for Coffee with Krav. We will be back next week, same bat time, same bat channel. We'll see you next week. Thank you. Have a great week. Bye-bye.
Thanks, Mark.